Broadcast is now starting. All attendees are in listen-only mode.
Today we are going to learn about capital market performance in 2018 and opportunities for 2019 in the webinar Investment and Economic Outlook for Public Entity Pools. This webinar offers a look at key investment issues and challenges addressed by small and large pools. It also includes a blind peer analysis of pooling clients across multiple portfolios to help participants understand investment risk and reward profiles. The session will be led by Daniel Smerick, Managing Director and Principal of Strategic Asset Alliance, SAA. Dan is the primary consultant for the majority of SAA's governmental risk pooling clients with invested assets of more than $3 billion. He has more than 20 years of experience across investments, insurance, corporate finance, statistical analysis, and information technology. Before joining SAA in 2003, Dan was Senior Vice President and Chief Investment Officer for a large regional medical malpractice insurer where he was responsible for treasury, asset management, and information technology. Dan has a BS in Managerial Finance and an MBA from the University of Nevada, Las Vegas. He also holds an MS in Finance from the Carroll School of Management at Boston College. Before I hand things over to Dan, I'd like to share just a couple of quick logistical notes. All attendees are automatically muted. If you'd like to ask a question, please type it into the chat question field on the webinar panel. We'll address your questions as we go if they are germane. Otherwise, we'll hold them until the end of the presentation. A handout is available during this webinar. To access it, use the Handouts pane in the webinar control panel and click the name of the file to begin automatic download. You can then save the documents to your computer. Last, an audio recording of the webinar and presentation slides will be available on demand for members on the AGRiP website in the coming week. Dan, I'd like to turn it over to you.
Well, thank you, Stephanie, and good afternoon, everyone, and thanks for taking time out of your afternoon today to cover some ground here and hear about investments from SAA's point of view in working with AGRiP. And with that being said, we're going to cover some ground here this afternoon in the time that we have. And just quickly, we're going to look backwards briefly. I want to spend more time looking at peers and looking forward into 2019. And so those are the three topics that I have to roll through on this slide deck here. First of all, on how did we fare in the past year, and looking at slide 2. And lots of colors and mixed charts on here, but what you'll notice from left to right are some of the broad indices across the world's capital markets for the U.S., international, for both equity and fixed income, et cetera. And for each of the columns to the right in different colors, you have the returns for each of those indices for the trailing year ending this most recently October, how they ended the year last year, October 17, and then the year before that, to give you some perspective. And what you'll see mostly is you see a sea of green for the last 2 years, except this year, where you see it's kind of split with everything that's been going on in the marketplace, and particularly what's been happening since October, which I'll get to. And with rates rising across the marketplace because of the Fed's policy, you see kind of a contrast between how the markets have performed the last couple of years. We've all enjoyed everything going up for the most part. And this is the first time in quite some time that we've seen fixed income returns actually negative because of rising rates, as well as some difficulties in the equity markets on a calendar year-to-date basis. And so that's kind of setting the stage for looking ahead into 19. And so first of all, well, did risk-taking pay off last year? Most of the pools with whom we have the pleasure to work have the ability to invest in other assets outside of, let's say, treasuries and agencies, although some pools we work with are fully restricted. And so this slide is just to give you an idea, well, if you did take risk outside of just investing in bonds, high quality bonds in your portfolio, were you compensated for the last 12 months ending November? And so this chart is looking at two components. The left is the return, and you can see most asset classes were negative or just up slightly, with the exception of the U.S. equity markets, that bright green beacon bar that's there, that's up almost 6% on the year ending November of 18. With international stocks being the biggest loser during that period. And then the next ratio with the same colors to the next metric to the right is Sharpe ratio. And this is a metric that says, well, were we compensated for taking risk by investing in any of these asset classes as compared to just owning 30-day Treasury bills? And you can see the answer was a resounding for the last 12 months, pretty much no, except slightly you got paid for owning equity. So this was the first time in quite some time where most folks were not rewarded for investing outside of Treasuries. But again, we're just looking at 1 year here. So when we put it in perspective over 3 years, on the next slide, things look a lot different. So this is the 3-year annualized return for the same asset classes you saw on page 2. And this slide deck is also meant to be a handout as well. It was a pretty good period of time for almost all asset classes except the bottom that you'll see, the U.S. Treasury 10-year, as rates have been rising, and also for crude oil. We've seen what's been going on in the oil markets. They're all over the place. But overall, if you were invested outside of Treasuries, and particularly in the equity markets, the U.S., you've had a pretty good 3-year run by investing not only in bonds, but any other type of asset class outside of investment grade bonds, if you had the flexibility to do so. So the question is, looking forward, how might we be thinking of these things? And on page 5 is, did you get paid for taking risk the last 3 years? And the same slide is on number 3. And the answer, return-wise, the answer was a resounding yes. You see U.S. equities there in the middle of the left grouping of bars, up on an average almost 12% per annum the last 3 years. Even that Barclays aggregate was up, 1% or so. Everybody got paid. And the Sharpe ratio metrics also to the right is effectively everybody got paid for taking risk. And so what we saw in some organizations is whether they were commercial or risk pool, some folks considered maybe, hey, we could take some more risk because we could earn more. And for those folks that tried that and so far in 2018, it's been a little bit of a trial thus far. So let's first of all focus on core fixed income. And why do we do that? Because that's the lion's share of how all of you are invested, whether you're restricted to governments or agencies, or whether you can fully invest across different asset classes. But the majority of your assets are going to be in high quality core fixed income to support your reserves and liabilities. And this chart on page 7 has all kinds of delightful numbers on it, but I want to focus on the bottom exhibits where you see the arrows. And the first bar there, that kind of pinkish bar, is showing you the disparity of returns between the U.S. bond, the aggregate bond market, which is the United States investment grade bond market, as compared to the global bond market that also includes the U.S. And what this metric is showing is the differential in yield between just investing in the U.S. or investing in the globe. And what you see as you go from left to right is the disparity in the changing complexion of the differences in rates in the world relative to the U.S. At the end of 2013, the difference between the United States and the global aggregate bond index, which I'll use my tool for the first time here, was 0.37%. We go out through the end of November, that difference was 1.35%. So translated another way, foreign investors could invest in the United States, and assuming they can hedge their currency exposure effectively, could earn 1.35% more by investing in the United States. So that has been over time, that has been put downward pressure on longer term rates. That has somewhat changed recently with the appreciation of the dollar, but I won't spend time on that today. The other metric that we have here that's been in the paper quite a bit is this whole 2 to 10 year spread, and that delightful term of curve inversion, or when the short-term rates become higher than long-term rates. And for the last 50 years or so, whenever that has happened, when the 2-year has exceeded the 10-year for a period of time, that has always been a harbinger of recession in the next 18 to 24 months. And so this is a metric that's being very closely watched. And you can see here the difference at the end of 13, the difference between the 2-year Treasury and the 10-year Treasury was 264 basis points, or 2.64%. That has collapsed as of the end of November to a mere 20 basis points. So in other words, you're not getting paid really to go out longer to take on Treasury risk for additional 20 basis points for 8 years of additional duration exposure. So again, the market's very much attuned to this and the Fed policy that's currently in place. Well, the next slide here, is I always have to remind people, is the yin and yang of fixed income investing. And what you see on this exhibit puts in a stark contrast the delight of investing in bonds. And what we see here is the blue line that looks like a very bad EKG is the price change of the, in this case, it's the Merrill Lynch U.S. it's the Merrill Lynch 10-year U.S. Treasury Index. And those blue oscillations going back to 1996 represent the price changes per month in the U.S. Treasury bond over that period of time. So you can see this is kind of a great poster to say for those people that say they can predict the direction of interest rates very closely are in for a hard show. But if you predict the income trends, what you see in the middle of this page is this red line, and see how calm and flat that is. And so with the spirit of the type of investing that we do, even though that you all have to market, underneath that mark to market, you're still earning income in the form of yield from your bonds. And that has been very steady over time. And more importantly, with changing rates recently, even though your unrealized gain position has whittled away and is most likely an unrealized loss position these days, new dollars are being reinvested at rates that are 100 to 125 basis points higher than they were just 12 to 18 months ago. And so this is the yin and yang of investing here. But the thing here about I always keep our eye on it for our clients, and we talk to pools and commercial clients alike, is we're really managing for yield over this time. And why that is the chart here on page 9 is breaking down that previous exhibit and saying, if you look back over these 3 decades and say, how much of my total return did I earn because of yield? The answer is resoundingly, almost all of it is yield. So from the period of 1990 to 1999, you saw 97% of your total return investing in bonds was not due to price change. It was due to the yield embedded in your portfolio. And the reason for the slight contribution to price change is because yields were generally falling through 1999, through those 10 years. 2000's the same thing. We see about 91% of the return during this decade was due to yield, with the residual being basically due to price appreciation because, again, yields decline. Only here in the most recent period ending November of 2018, starting in 2010, you see a different relationship now in that actually pricing has been negatively contributing to return for bonds, and more than your return here in order to equal out to 100% of return. All your return for this most recent decade has been due to yield management as of the end of November. And that's an important distinction, again, just tying back to the previous slide, that it's really all about managing yield over a long period of time. What's happening on page 10 is just for those of you that don't get to live the dream like I do and look at bond math all day long, is on the bottom right. I'll highlight the red triangle. This is what's been happening. This is showing you bond math in work. You have hypothetical bonds of 2.5 years, 6-year, and 12-year durations, another approach to maturity. And this is saying, well, what if rates went up 2 full percentage points? They actually have over the last 2 years. What does this mean to bonds of short, medium, and long duration? It means your price is going to fall. And the longer the duration of your bond, the more your prices have fallen, which helps explain why the unrealized loss position in portfolios has grown so significantly really over the last 18 months. And so these are the metrics in play. The corollary to this is that these are not real losses unless 2 things occur. One, you have a credit event. You own corporate credits or instruments that have credit exposure, and the underlying credit of that instrument goes south and you have a loss. Or you have to, worst case is you have to realize a loss to generate cash for operating concerns. And that's probably the worst position to be in that we've seen with pools off and on over the years. And we hound about cash management, although that can be difficult sometimes, is because if you have to crystallize losses, for instance, in government bonds or agencies or high quality corporates and realize a loss to help offset operations, we know it can happen sometimes, but you'll never earn that back just given how low yields still remain. So just something to keep in mind, but also just highlighting what's going on in the marketplace from the mechanics of bond math. On page 11, you all have different managers that are out there, whether you do it internally or have you've outsourced your portfolio. It doesn't matter what these managers say. There are only so many levers to pull to deal with yield in your portfolio. And here's like kind of the top 8 in order of, we have duration, we have convexity. Convexity is one of those cocktail party words that can get people to step away from you in an instant. But what it really means is how sensitive is duration to changes changes in interest rates. So in cash flows, how your cash flows in the portfolio would change. Convexity is associated with if you own mortgage-backed securities and the prepayments that come in change with interest rates. That's what convexity is. Yield curve, where you invest along the curve. Are you short? Are you long? Not all yield curves are as flat as the Treasury curve that I talked about a moment ago. Credit curves or corporate bond curves and commercial mortgage-backed curves, those are steeper than the Treasury curve. Something to keep in mind that you'll hear managers talk about. Sectors, well, where are we invested? There are really three major sectors. Again, no matter what fixed income managers tell you, it's the holy trinity. We have governments and agencies, we have corporate bonds, and we have structured securities. And structured securities include anything that's an acronym, basically. Mortgage-backed securities, MBS, asset-backed securities, commercial mortgage-backed securities, anything that's basically supported by another asset that's been packaged. Those are the three areas where managers will rotate through when you hear about broad sectors. Security selection is important, how they choose bonds, how they go about that. Quality, if you're higher in quality, your yield tends to be lower. The corporate bond market's changed dramatically the last 15 years. Almost half of the corporate bond market is rated BBB. That makes things interesting when you use that as a benchmark, when most portfolios don't have that amount of BBB. That's for another day, but something else to think about. Liquidity. This means many things to many people. Liquidity typically is if I need to sell something and I'm carrying it on my books at 100, can I sell it close to 100? Or is there friction when I go to sell that people don't want to buy this particular bond and maybe I can sell it, but it's trading at 80? Those are many things about liquidity, and you can manage liquidity in your portfolio. And frankly, most portfolios that we work with, whether they're commercial or pools, tend to, I would argue, have too much liquidity and could probably pick up yield by managing their liquidity profile a little differently. And lastly is structure. On the vast propeller heads and geniuses out on Wall Street, I say that somewhat facetiously, they keep coming up with products that people that are in many ways good and cater to certain investors, but you just have to be mindful of how they're structured, how cash flows get allocated to the investors, and that's why outsourced investment managers are typically good to have, and they need to have a good, strong department. But that's something for another day as well. But these are the levers that you can pull to manage your yield and risk exposure in your fixed income portfolio. And that being said, we're going to hop into risk assets. And for those of you that can consider risk assets, you know, the age-old thing is, and I've used this slide before, is, you know, time, diversification, and the volatility of returns. And I'm sorry I didn't do the sourcing. This is a JP Morgan asset management slide, but I've seen it across numerous managers. And what this is just showing you is looking back at the returns of the stock market, the bond market, and a blend of 50-50, the returns over the last 67 years. And showing you, if you look at these in a one-year profile, which is the bars on the left here, and you take that whole period of time and you look at the best return for the stock market in a 12-month period and the worst return, you can see this represents the equity market. We have the blue as bonds and we have this 50-50 in gray. Well, if you're just looking at the one-year metric, you could say as an investor or a board member, boy, if I invest in equities, I have a chance I'm going to lose 39% in the worst possible year. Well, the answer to that, yes, that did happen. However, if you look out and hold these products for 5-year periods, the rolling 5-year periods over the last 67 years, notice that minus 39 just disappears. And if you look more distant, which is typical, I would say, for the going concern nature of risk pools, is the 10-year and rolling 20-year periods. It's almost negligible on what the downside risk is when you think about it over time. And that's typically a disconnect that can occur when we're talking about asset allocation with clients, because we have folks that will, and rightfully so, that will be very much concerned about 1 year, 2-year exposure, thinking about, well, can we endure this and lose sight of this, when in fact we need to keep in sight both of these types of things when we think about investing in risk assets. And risk assets, for those of you, means anything. We all have to have our nomenclature, is anything that's not an investment grade bond. So this would include equities, high yield bonds, international equities. Bank loans have been in the mix for a while now, a new buzzword, but basically anything that's going to be a higher risk, higher return asset class, as opposed to high quality investment grade bonds that we just talked about. And so keeping that in mind, let's go to the next slide that says, well, over the last 10 years, how have these types of risk assets that are broadly used across pools and the industry, how have they fared? And so what you see on the top in the chart with the different lines is the rolling 3-year return of any of these particular assets. So I'll focus on the red line first. And so this is the Russell 3000, which is another metric for the US equity markets. And at any point along this curve, it tells you the 3-year annualized return as of that point in time, and I'll use the end here, as the end of November was about 12%. So for the last 3 years, we've averaged earning 12% a year in equities. And you can see how the rolling period, equities have had a pretty good run since the Great Recession after they recovered. And being in equities has been very, very good relative to being invested just in treasuries, which is represented in blue. And you can see what's happened here, where we had yields that were up after the that were basically in place before rates started to decline after the Great Recession. And with the declining in rates, now they're coming up. You can see what happened to returns in the bond markets generally as they went down, as the Fed policy loosened, and they only recently started to tighten. And then you see what happened with high yield as well. High yield's been a pretty good place to be, except we had a little hiccup here in 2016 with the energy hiccup. But generally, that's been a pretty good place to be. But more importantly is diversification, the only free lunch I'm sure you've heard. And I just put in for illustrative purposes here is an 85-15 mix of the Barclays aggregate investment grade bond index and the Russell 3000 US equity market. And you can see how much better that performed with a similar profile, volatility-wise, as both of the fixed income markets. And so that's just an important distinction, again, when we think about asset allocation. And I'm sure you've all seen this, but oftentimes it gets hung up in equities maybe too risky or other asset classes. But when you really put them all together and you start to do some back testing and even some forward-looking assumptions based on downside, things don't look nearly as rough as they are. Of course, that's dependent upon your surplus, how you want to use your surplus, where it's going, your membership, other things. So let's take a look at that. So we've talked about fixed income and we talked about risk assets. Well, let me show you how they are in action across some of the pooling clients that SAA works. And so we have this blind pool analysis, my first typo of the day, hopefully the only one. This pool analysis is as of the end of September of 2018, thanks to my colleagues in Bellingham putting this together. And so it represents our 18 pooling clients, 25 portfolios, 19 primaries, so first dollar coverage pools, and we have 6 reinsurer pools, about $3 billion in assets, and you can see the mix there. It's about 80-20 across that. So we spend most of our time in core fixed income, but we do have $500 million plus of that invested in risk assets, and you'll see how those are allocated shortly. So let's talk about core fixed income first, how people are allocated. On this exhibit here is just highlighting a couple things of the key metrics that we look at for fixed income in a summary type fashion, and that is the duration, which is the broadest metric for the type of interest rate risk you have embedded in your portfolio. And as a rule of thumb, you take duration and you use, if the Fed raises rates 100 basis points and your duration is 4, you're going to lose 4 percentage points of value if that happens. And so that's just a rule of thumb. And what we have here is just showing you those pool clients, as well as to give you some context between the intermediate aggregate and the aggregate bond index, both by Bloomberg Barclays, and just showing you where most of these pools lie. And these are pools with different types of exposures across health. We have health trusts, benefit trusts, we have property and casualty, we have workers' comp, we have liability pools exposures, excuse me, across the gamut, which is why you see some of the disparity here. But if you look at an average and a median type approach, most of the portfolios are in the 4% range, the 4 to 4.5 range in duration. And book yield's been ranging between 270 and 280, and there's upward pressure on this as compared to I looked at this a couple of years ago. And so this is just important to give you kind of a context to say, well, what's going on over here? Well, this is a health trust pool here. And over here, this is a long reinsurance pool over here. And so somewhere, in the middle, the question is, where does your portfolio lie and why? Are you comfortable with certain types of exposures that are embedded in the investment policies for each of these dots? But generally speaking, most of the portfolios tend to be intermediate in duration, with a couple of exceptions, and have yields right now that are in the 2.5% really to 3% range. And the key thing is, regardless of where you are, there's upward pressure on those yields as reinvestment rates continue to get higher. So how are they allocated with that last group? So on page 19 is showing you, and I broke it down into colors here in the chart, and this is sorted by folks who have the largest allocation to non-U.S. Treasury and agencies, basically. And so what you see here is going from left to right, and on the bottom we have I'm sorry I don't have it, I apologize for the lack of a legend here, but RE stands for reinsurer, P&C self-explanatory, and health. And so what you see going from left to right are the pools that have the largest allocations away from U.S. Treasury and agencies and cash. And you can see some of the pools, the one on the far left you can see has an allocation that basically 85% of that portfolio is invested outside of Treasury and agencies and agency mortgage. It's primarily a credit portfolio across structured securities and corporates and municipal bonds, in this case, taxable municipal bonds, given the general status of most pools. And you can see the components, the max, min, and median average down there. I'll just have to say, typically the portfolios that we see that have more diversification into these other asset classes when it's available to them tend to have better risk-adjusted profiles over time, both on a total return basis and, more importantly, the quality of their yield that's in their portfolio. When you look at it by credit, is on the next one. That was another one of the levers that I mentioned. You look at credit, and you're going to go from left to right, the same type of thing. So the firm here, who has the most credit exposure, and I grouped AA and AAA together because their default profiles historically are very similar, and single A's and triple B's look different. And you can still see that most of these portfolios, even though the previous page shows the disparity between all the allocations between corporates and munis and ABS and CMBS, the quality is still very, very high in those, as represented here. We're not really taking on significant credit risk. We are taking on credit risk, but maybe not as much as the previous slide if you said, oh, all right, look at all the corporates they have and all this. Well, not necessarily. A lot of those instruments are very high quality rated, and again, something to keep in mind. But taking credit risk these days, is always, you have to be always very careful and have a manager that's doing the actual work and understanding what's the underlying risks in those, as opposed to just relying on the rating agencies as a standalone. Well, let's look at risk asset allocation now across this same group, this peer group here. And so we look at risk asset allocation a couple ways. Typically, when we first talk with pools or commercial carriers, oftentimes they look at it purely from, well, how much of our total portfolio is invested in riskier assets? And so that's exactly what this is looking for. So looking at your portfolio is 100%, how much of it's invested in riskier assets. And you can see we have some clients that have a significant portion of their portfolio as a percentage of the total invested in riskier assets, with a median and an average between about 16 and 18%. It's somewhat skewed because you can see 3 organizations all the way to the right on this exhibit, a health and 2 property and casualty pools that are not allowed. One actually could but does not invest right now, although we're trying to change that. And the 2 P&Cs are actually prohibited from investing in risk assets. And I just put those in there again to make my point that I have earlier. But oftentimes this metric can be misleading, because what we're really interested in is how much of your surplus is exposed to investment risk. And so the metric that we tend to place more faith in when we look at your allocation is what percentage of an organization's surplus or net position is invested in risk assets. And so we look at this same exhibit and we translate what it said of the total portfolio, but now let's see how much of your surplus is at risk. And why we look at it this way is your surplus has many demands from your underwriting, from your reserving, from your risk management, from the stuff you don't know about and what the legislature is going to push down on you presumptively, depending on the state you're in. And so what we're looking at is, of all those different pressures on your surplus and potential uses for the best interest of your members, investments is just one component of that. But in this instance, we have some folks that over time have found that for them and their type of book that they have is that investing more of their investments outside of core fixed income has actually worked very well for them from a diversification and a total return point of view over time. And that's what's represented here. As you see, a few of these have north of 50% of their surplus is invested in riskier assets, with a median and an average about a quarter. Well, I just raise this because typically when SAA dives into this and we do education or we get asked this question by pools, well, what's a type of investment you'd consider to go into riskier assets? Well, generally we like to start at 25% of surplus to start the discussion, so we can show what type of volatility or lack thereof would be introduced to your surplus. So I just raise that as kind of when someone asks me what's a heuristic before anybody does any modeling that doesn't have risk assets, is we say, well, let's see what 25% looks like to see how that may or may not make folks feel comfortable, particularly at the board level. When we look at risk asset allocations, well, how are these folks allocated? And you can see they're allocated very differently depending on the organization, but with one theme in common. You can see those bar charts, those stacked bar charts are a sea of blue. And primarily, the first thing, of course, that most pools understand and are comfortable with in investing in outside of bonds are U.S. equities. And that's the lion's share that's here on this page. And then after U.S. equities, international equities typically come up. Then high yield bonds and or bank loans. And other, in this case, happens to be a global bond fund, which has now since changed moved out. That's in purple. But generally speaking, is the first step really is to think about U.S. equities and the various styles that are there, and then think about higher yielding fixed income asset classes such as high yield bonds or bank loans, and then international equities, and then this wonderful term alternatives that you can put in quotes, which is basically is anything that people don't understand, or what Wall Street may be trying to hawk to say, hey, we can earn money in all types of market conditions. You have hedge funds, you have all kinds of things. We certainly are aware of all those. We don't have any pools or frankly any commercial carriers that really utilize those. People love to talk about them, but typically in practice, they don't get implemented. So I'd say the biggest thing we're working on now, and what we see is folks seeing, are we comfortable with our equity exposure, or are there other lower volatility risk assets, high yield bonds, bank loans, et cetera, that may fit into how this allocation looks that you see here on page 24. Investment leverage is another thing that often gets overlooked just in an SAA's experience. And what is investment leverage? As I say, well, it's your invested assets divided by your surplus or net position or net assets. And this is complementary to your reserve leverage exhibit 2. And so what this is just saying here is, regardless of where your surplus, your risk asset allocation to surplus is, this is looking at things broadly and saying investment leverage, the more that you have invested relative to your surplus, the more sensitive your surplus is to changing in investments. Right? It's as simple as that. And so what you see on this page is another metric we look at when we think about allocation, and we recommend pools as well, is to say, well, like all the way on the far left here, we have a pool that has 400% invested assets to surplus ratio. So even if they were invested only in treasuries, the fact is they have such a leverage difference between their surplus and the investment portfolio. That portfolio is going to have much more volatility just due to general changes in the investment markets, as opposed to those pools that are to the right on this exhibit. So just another way when we think about and suggest to pools, when we think about risk, there's so many different ways to think about it. But the two primary ones when we think about investment and strategic asset allocation for pools is we think about risk assets to surplus, and we think about investment leverage, and those two broad components before thinking about strategic asset allocation that is in support of what you're trying to do for your members. Well, now let's look at performance. So how did these do? We talked about allocating. Well, how did we perform? Well, if we take all these portfolios together and say, well, how do we do for the year ending September 30th of 18? Well, in fixed income, it was a little bit rough. Why? Rates have been rising, so we've seen our unrealized gains, if you had those, go away. At worst, they're now changed into unrealized losses. You can see the markets are just as difficult. You're still earning income during this period of time because you're collecting that coupon, that flat red line that I had on that 10-year Treasury exhibit. And yes, we do have one firm that's up here that's had positive. Why? Because it's a health trust and they own a lot of floating rate securities. Then they're very short. And so as rates have risen, they've actually benefited from rising rates. But again, they're different than the majority of the pools with whom we work in that they're very short health trust. So it's been a tough year for fixed income, I'm sure, for all of you on the phone. So how do we look over the last 3 years? A little different. Still includes what's happened during the most recent year as rates have picked up. And so if you look on this chart, the total return on the vertical axes here, it's not very inspiring. Is that at the most we have a couple of pools that have earned 2% over this period of time. And of course, the twist here is that 2%, both of these pools up here in these top dots that I'm highlighting with my little hand here, both of these folks have yields that are north of 3.5%. So even though they're yielding 3.5%, the fact they've only earned 2% over the last couple of years just is another example of how quickly rates have risen, that even that income that they've earned over the last 3 years, so figure about 10% in income, has basically been reduced down to 2% because of the change in pricing, because of yield increases, particularly over the last couple of years. Management fees. This is always a humdinger for those of you out there. So first of all, I will say anybody who is north of 25 basis points on this line, you need to get on the phone. We have one pool client. I'm happy to say that is now going away. That'll be down to 15 here, effective here in a couple days. But generally speaking, we continue to be very pleasantly surprised at how fixed income management fees have continued to come down, or firms offer additional services such as investment accounting and other things. And I'd just like to highlight for those pools out there that are both small and large, at this 12 to 15 basis point range, I want you to notice there isn't a lot of slope in this line. So if you're a smaller pool, a lot of these fee savings are available to you as well. when I look back over the last 10 years, these numbers have all come down 8, 9, 10 basis points, which really just benefits everyone. So if you're a smaller pool out there, or if you're a pool that's paying really north of 20, start to get a little grouchy, but if you're paying north of 25, you really need to get on the phone, because this represents about 12 different investment managers around the country of different sizes and shapes. And you can see that the fees are all very comparable in here. Well, let's talk about risk asset performance. So we got the 1 year ending September 30. And this exhibit I've done a little differently. We have risk assets as a total, here's total return performance. But given that allocation exhibit that I shared a moment ago that said, since most of the folks are invested in U.S. equities, I said, well, let's do the horizontal axis this way, that says, what percentage of your risk asset allocation for folks that have it is in U.S. equities? So in this case here, there's a couple firms here that they only invest in U.S. equities, and this shows their total return for that period of time. And then in the middle of the page, the colored dots just give you some perspective as to, I have 4 benchmarks in here: the S&P 500, the U.S. equity market, EFA, which is the developed international markets, the world equity markets ex the United States, just to get a sense on how the developed and the emerging market equity markets have done without the United States, and lastly, high yield, just to give you some contextual view. And so you can see folks that tended to have, because the U.S. was just a strong performer, folks that had more allocation to U.S. equities had higher total returns for the 1 year ending September. If we look at the 3-year period on the next page, we have the same thing, is that for the most part, people in the U.S. equities had a better luck of it, had less diversification, but had better total return over this period of time. And really the thing we'll start to see is, well, did investing in risk assets help the total portfolio? And that's what we're going to talk about next. And so if we look at, you put all this together and say, well, how did the whole pool do, fixed income, risk assets in a total portfolio sense? And the answer here is just showing you, first of all, on the vertical axis, total return again. In this case, risk asset allocation for the pool as a percentage of its surplus. And here are the 2 bond markets, the aggregate and the intermediate aggregate, and the 1 health trust. But you can see anybody who had risk assets in their portfolio over this period of time outperformed just investing in bonds, just for the 1 year, even think what's been going on. And for the 3 year, it's even starker. You see over the 3-year period, even though bonds are up 1 and 1.5%, folks who had risk assets in their portfolio tended to outperform to a significant degree as they moved out along here. Again, bearing in mind that they could absorb that risk. So some of this is, you could argue, well, somewhat obvious. Well, yeah, if you have riskier asset classes, you should get paid for those. Well, it's a pretty good time to be in there for these years. But yes, generally over time, and if you have the capacity, you will absolutely have a better return profile, risk adjusted, by able to diversifying into some of these asset classes. And you can do so by actually earning income that's comparable or even higher than what you may in your core fixed income portfolio, depending on what it is you're trying to accomplish. And so with that, let's look ahead now. I think that's the most important thing of this. I'm sure you're going to hear a lot of talking heads between the TV and what you listen to on satellite radio. So now you get to hear, SAA's point of view on some things and working with pools. And so I'm going to talk about a few themes. And the first one here is, evolving risk management. I've used this slide in the past. The iceberg analogy is perfect for what we do, because we have on the top, we have the risks of which we are aware and actively measure and monitor, whether it's through our dashboard reports and all the system changes that are going on to better align underwriting and reserving systems, et cetera, to get better information. And then we have underneath, we have the risks that we are currently unaware or aware of and underestimate. A prime example of this recently is sitting in on a lot of board meetings and listening to the presumptive coverage issues that are flowing through the legislatures across the country. And what does that mean? Ultimately, it means the members are going to pay more, but what does this mean in the interim for pools that price this or their reinsurance partners? And so that's another example of what's underneath here, and we have to manage for that, whether we like it or not. And so when we think about that, that's just kind of a framework when we think about the investment program as well. And the biggest thing now, I have a few themes here. World debt levels. This is something that you can see going back to the end of Q 2003. World debt was about $100 trillion here. About 100 trillion. And now you can see we're up to $250 trillion as of the end of the first quarter of 2018. And so this is an issue I'm sure you've been seeing in the newspapers from time to time, whether it's China's actual debt or shadow debt, whether it's our debt, undisclosed pension debt for municipalities, all kinds of different things. But at the end of the day, this is going to have to be paid for somehow, whether you're a central bank or not. And so most recently, rate increases, of course, propose somewhat of a challenge because it makes the federal debt cost more than it has for quite some time as the Fed has raised rates. And so this is something to keep an eye on because leverage works both in positive ways and negative ways. And ultimately, this will have to be dealt with one way or the other. I wish I had answers, but it's something that's going to amplify the potential for yields on where yields would go, because if people need to finance debt, they have to have a rate that they are willing to pay in order to get buyers to come to market. That's something I think we'll start to see as rates if they continue to tick up higher. The Fed. Well, of course, we all know about the Fed. The Fed's tune has been changing quite a bit recently, particularly with the hunt for search for the red October. It was a tough October, but this is just showing you the Fed funds rate and where it's been and then where it's projected to go. And over to the right, what's interesting is just showing you, what the FOMC, so the market committee, is projecting where they think the rates are going to be and where the long run projected rates are going to be, about 3%. Well, the market expectations in September are basically saying, well, we don't think that's going to happen. And as of market predictions today, there's now like a 60% chance now, according to one of the market metrics we look at, that they're going to raise rates in December. And in many ways, there's projections that there's going to be no rates in 19. I wish I knew the answer. All I can say is it's dramatically changed just from this summer, where markets and investment managers were saying, we believe that there's going to be 2 more rate hikes for the rest of the year, and we may see 3 or 4 in 2019. Well, now 2019 is totally up in the air as compared to where it was just 6 months ago, but yields are still higher. And also, just one fact, millennials out there, this is the highest they've ever seen mortgage rates in their adult life. And so that's kind of a wake up for them. Although those of us that had mortgages long ago, we kind of scoff when they're complaining about 5% mortgages, because I'm sure there may be a couple folks on the phone that, may remember the days close to 9-10%. So I would say the whole Fed thing is in flux. The thing that's consistent about the Fed, in our view, is they've always said they're going to be data dependent. So unless that changes, which would cause, in our view, pandemonium on a few fronts, unless that changes, they're going to be driven by employment, inflation, et cetera. And so that kind of brings us to, inflation on page 41 here, which is showing you the 10-year Treasury going back to 1958. And you can see the rise of the Treasury yield to the Reagan-Volcker era, so Volcker, the Fed chairman, and you can see the quashing inflation. We've been in a bull market for bonds ever since. And so we've seen yields decline for the last, 30 years, and only recently have they started to pick up. And you can see that on the right end of the scale, and on the grayish line is showing you the real yield. And so that's the 10-year Treasury minus CPI. And for the first time in quite some time, really for the last few months, we're actually earning real returns, which is somewhat miraculous when you consider going back the last 5-6 years, we've been in kind of financial repression as a term, where effectively savers were not being rewarded for saving. They were basically eroding their savings. At the same time, we're finally having some positive real yield. It's still difficult to keep up with some of the inflationary components in our liabilities that I know you all write, whether it's workers' comp, you have medical inflation, et cetera. It's still difficult to keep up with inflation on those categories except through pricing. So unemployment and wages, this is again, with charts galore here. I'll go all the way to the right. Unemployment continues to fall. If you've been watching the news lately, the latest is that there's 7+ million job openings unfulfilled across the United States. It didn't say the quality of those jobs, but for the sake of argument, let's say that those are jobs that could be filled and provide living wages. They're not being filled. And so that creates an issue with a tight labor market, and wages have been rising. And one of the things of concern with wages rising is that going to put undue pressure on inflation, which is a metric the Fed is looking at in order to help their propensity to continue along the path to raise rates to that normal level of 3% that I addressed on the previous slide. But my issue with the rising wages is a couple things to think about. On this slide is looking at the U.S. economy. It still continues to putt along. Q3 came in up 3.5%, year-over-year change 3%. If you look at there's charts broken up into two components. The first side is looking on the left is real GDP going back to 1968. And if you look at this, you can see the gray kind of look like for you fishermen out there, it's like looking at the bottom of your favorite fishing lake here it's all over the place. And you can see the average of GDP during that period of time is about 2.7% on average over the last, in this case, going back 50 years. But The recent expansion since the Great Recession is putting along at a slower average rate than that, at about 2.3%. Well, the takeaway there is, and you've all been beaten senseless, I'm sure, with this, is on the right here. If you look at the components of the United States gross domestic product, the broad metric that's looked at for economic productivity, and if you like to read op-ed pages or have trouble sleeping, there's a lot of views on whether is GDP really capturing all the economic activity. I mean, GDP goes back to post-World War I. And so if you look at consumption, about 70% of GDP is you and me. And so to the extent that we have more money to spend through wages, or we feel good about the economy, sentiment, then that helps move along GDP. To the extent the reverse happens, and I'll give an example of what happened in 08 and 09, what's good for you individually may not be good for the markets, is if you're holding back on spending because you think things are going to get tough, and that's good for you're saving more and protecting, but if everybody starts to do that, then consumption starts to go down. And if consumption starts to go down, GDP starts to go down, and then everybody starts to feel more worried again. And so it's an interesting phenomenon, and I certainly don't have an answer for it, but it's an interesting phenomenon why we look at sentiment gauges on what's going on with how do people feel, whether individually, small businesses, et cetera. Because if a larger group, if everybody keeps hearing, hey, we're going to have a recession in 2020, hey, we're going to have a recession in 2020, there's an element psychologically that says, well, hey, looks like we're going to have a recession in 2020. We probably better prepare. So there are elements to that to keep in mind, too, when we're thinking about investment allocations and expectations about how our economy is structured. China is not like this. China is about 30 to 35% consumption based. The rest is controlled by the government. And so they're hoping to be more like us and have controlled their destiny that from a consumption point of view. But I just raise that because I don't necessarily buy the rising wage is a potential tremendous a negative from an inflationary front when folks are going to have more money ultimately to spend for the benefit of their families and their communities. Well, good grief, we got to talk about trade. So we're talking about trade here. This is an exhibit showing you the America's top trading partners value, the total value of imports and exports in end of 2017, and you can see from left to right, the big three. We got China, Canada, and Mexico, and then Japan. And we've already negotiated individual treaties are in the final stages. Hopefully some of those will hold regardless of your political bends with Canada and Mexico. And now we're having fun with China. And so right now, is it talk versus tariff? We're kind of on the fence right now. You've seen the markets oscillate between trade talk. We go back to last weekend at the G20 announcement was we saw the smiling faces of China and the U.S. as leader with no substance behind whatever the deal was. And then the markets reacted beautifully on Monday, and then they blew up on Tuesday. And now, of course, we have the CFO that's been arrested in Canada temporarily, seeing for potential issues with violating Iran sanction issues. That's also potentially going to be an issue with China trade talks. So I just raise this because SAA's general view is there is huge incentives on both sides of the ocean here to get this right, at least to have something in place, because it certainly has dramatic effects across both economies over a longer period of time. This isn't a one-sided issue. So something to keep in mind, again, that we're eyeballing, and of course the markets are very much looking forward on all of this, because if you look back at the markets and how they've performed, let's look on page 45. We've seen a lot of these organizations that are here, the FANGs. Hey, for those of you who don't know this, another acronym for you, Facebook, Amazon, Apple, Netflix, and Google, the FANG stocks. A lot of these organizations, as well as most of corporate America on the heels of the tax law changes, have had tremendous corporate earnings this year. I mean, tremendous tailwinds, but the market's pretty much gone, well, yeah, that's fine. We already know about that. What have you done for us lately? What are you doing next? And so as a result, markets are always forward-looking. You can see what they've done to these tech stocks with respect to the trade implications on where the tech comes from, where things are made, et cetera. And you can see the FANGs have certainly weathered that on that front. And how ultimately I think the real issue is, and SAA has said in reports previously, and not alone, is, there's intended and unintended consequences with everything. And our greatest fear is that, the markets will sort things out, but the issue becomes what are the intended and unintended ultimately consequences of a extended trade war or concerns, and how that's going to roll itself through the global supply chain, because we're so much more interconnected than we were and than we are, much more so than we think. And so how is that all going to work itself through the system? So we think that there's a tremendous incentive to get something done for the sake of looking forward for both organizations, but I won't hold my breath too long. And why is that? Well, on page 46 is just the world economy in one chart. You got $80 trillion world economy. If you just eyeball this quickly, you got three broad areas. You got Asia, you got China, the biggest chunk over there, the United States and North America. And then in green, you got the Eurozone, which has a lot of equivalent players in it. But those are the three broadest economic zones. And so you look at those and how trade revolves around those and through those three major economic regions in the world. And again, back to my point earlier, how is this going to disrupt global supply chain? And are you going to, we've already seen it potentially with GM saying, hey, we're going to preemptively close, not only because people aren't buying these cars, but maybe we need to preemptively deal with some of these things in preparation for something that might be a little more protracted than it leads us to believe right now. So again, just something to be mindful of, and we're certainly thinking of that in our asset allocation thoughts, depending on whether we're looking at short-term or long-term. So let's wrap up, folks, here and leave you with a couple things. I had the privilege of speaking at AGRiP's Fall Forum and think about trends and next generation investing. And I just wanted to raise one slide from that, and these three components is that we have some things working for us or against us. In the broad sense, demographics, the developed world is getting older. And as the developed world's getting older, that means the rich world's getting older. And what does that mean to us looking ahead as different types of the sectors, whether it be healthcare, consumer staples, medical devices, et cetera, those types of things? How are demographics working for us and against us, particularly China? One of the issues with China is, China, and I don't think I have the exhibit in here, but China with their one-child policy going back a generation and a half, they may get old before they get rich. And when I say rich, they may be the largest economy in the world right now, but when you look at it on a per capita basis, they're not anywhere near the United States. So demographics, when government regulation, what's going to come out of Congress and the governing bodies thereof, that we're always under that, how does that roll itself down into our localities and how that ultimately manifests itself in the types of issues that you as pools have to do? And of course, technology is just ever evolving in the investments, in what we do in our platforms, data management, turning data into information, all those things. None of this is going away and are going to manifest itself continuously as we look into 2019. The real theme for you all this year is volatility is back. And so this metric here, the VIX index, is the volatility index. It's measuring the volatility really of the options market for the S&P 500. And so what you see here are just these delightful metrics here of the annual index move on how volatile it's been. So you go from left to right. 06 calm before the storm. 07 and 08 volatility was huge. After 09, things have been pretty calm, and now it's back in to the end of 2018. And we would expect this to continue in the 19 for a couple of reasons. The trade issue that I mentioned, we have now a split Congress. We have other things that are going to be afoot, and we have this specter of are rates going to continue to rise, and what does that mean to home ownership, servicing debt, all those types of things as we move into 2019. There are allocations that can deal with all of that potentially, but just how do you keep that in mind as we're looking? So volatility is certainly going to be back, and you're certainly going to see, as you all are mark to market, whether you're just bonds or whether you have bonds and risk assets, you are certainly going to see, in our opinion, more surplus volatility from investments this year than you have in the last 2 to 3 years. And when we think about things, just wrapping up the last couple of slides, is we always like to have folks think about, we take an ERM approach to risk management and investments. And so in the middle of this page, you see we got surplus or net position. And we really have the four major components that we all talk about, and I alluded to all these speaking today, is we have operational risk, which can be very nebulous. It's the people that go home every night, your organization, your institutional knowledge. We got underwriting risk in our pricing models, et cetera. We have reinsurance and reserving risk. And investment risk is just one component of all these things, which is why I kept emphasizing investments are a support role for all the other things that you do. And can we take a certain amount of risk in the investments that are going to better our ability to be flexible across these other three components in this exhibit I have here? And underneath here, how much surplus does our pool need? Everybody's different. We have the amount we need from our actuaries. We have the amount that makes our board members and committee members comfortable about the risk exposures that we're comfortable making or taking or having forced upon us. And also contingency. How much of a contingency cushion do we have, particularly those of you that basically insure the majority of your markets? So I'd just like to highlight this because this is how we think and encourage people to think about their investment process. It has to be completely intertwined and meshed with what we're doing on all the other fronts on your business in order to support surplus for the benefit of your members. And what are some of those opportunities on 51? This is a slide I've used over and over. It hasn't really changed. So for those of you on the left that are highly constrained, first of all, I'm sorry. It's unfortunate because it's really a shame because there's so much more diversity and flexibility that those organizations could have that in some ways, in our view, aren't subject to some of the municipality rules thinking longer term, but that's just the way it is. And so you're very limited. So in those considerations, you have duration extension, although you're not getting paid for that now. We've seen some firms that say they don't use agency mortgage backs or commercial mortgage backed securities in regulations where that's silent. That's a place we've helped pools look at who've only done treasury and agency bonds, but they didn't use agency mortgage and CMBS. That's helped improve yield. You got subordinate agency debt, you got brokered CD programs, but really you're pretty much limited to lower yielding overall. For those of you on the right, flexible investing, I talked a lot about that today. You can invest in pretty much anything that, let's say, an insurer could do in your jurisdiction. And considerations, I think the broadest thing that we typically do is increase non-treasury allocation because you get paid for it, risk adjusted over a long period of time. Changing your risk asset allocation to surplus, if you have that flexibility, back to I'm saying, start at 25%. And see how you do, and then take it up to 50. How do you do it 50, 75? We don't have anybody at 75, but how do we do it 50? There's one person out there that's over 100, but that's Warren Buffett, so you know he doesn't count. And then we have alternative asset classes I mentioned. As people become more interested in asset classes, again, I mentioned bank loans here, but are there other asset classes? There's some of these go anywhere funds out there that have some potential merit. But more importantly, I put in red is, enterprise risk management driven strategic and tactical risk assessments. Those are things I know a lot of the pools out there have done surplus use, surplus target studies. What does that mean? Put it in that context. ERM, enterprise risk management. How does investment fit into that category, given all the other things we might try to model? And bearing in mind, all models are wrong, and some are useful. And always keep that in mind, because it's amazing how I've seen some very bright people get sucked in at what models are telling them and not questioning the fact that models are just merely a tool to help you see other things. And lastly, I used this slide a couple of years ago. What's going on at the regulated organizations, at the NAIC, is this ORSA concept, your own risk and solvency assessment. And this is something where some of the pools out there who've done their surplus target, surplus use policies, et cetera. I just want to highlight this again because even if it doesn't affect you now out there, it's coming for you because your regulators, even if you're not regulated, people are going to be asking you questions. And to the extent you don't have answers to some of the things that are on this page, in SAA's opinion, you're going to be at a distinct disadvantage compared to some of the other pools and even some of the other very small insurers out there who are going to have answers for some of these very basic questions when people come knocking on your door to say, how are you being managed? What are you actively reviewing from an enterprise risk exposure point of view? And with that, I have used my allotted time, and I appreciate all of your time. And I'd be happy to take any questions, but more importantly, thank you, and I'll turn it back over to Steph.
Thank you, Dan. We do have a question. One of our members asks about the slight inversion of the yield curve, and they say, besides being an indicator of future economic growth and activity, is there anything actionable or anything you read into the recent slight inversion of the yield curve? Is there a way we should be monitoring and or responding to that change?
Again, our opinion is, there have been short-term inversions. For instance, the 2 and the 5 year shifted this past week. The question is whether it's sustainable, and I think that 2 and 10 year is probably the best bellwether when we look back historically. So if that's something that stays around for quite some time, it's been a harbinger for the last 50 years, as I mentioned, as a recession indicator. Although every time, if you look back in literature, someone always out there says, hey, this time it's different. Well, the first person who said that this time may be different was former Chairman Ben Bernanke in July in an op-ed page in the Wall Street Journal that said, given the unprecedented central bank policies around the world, being inverted may actually be a little different this time. I wish I knew the answer. But one of the things I would say is with that is we've certainly had folks be a little more defensive in their interest rate posturing in their portfolios, and most managers have taken their duration posture a little bit shorter than their benchmarks. And I'd say that's probably the broad thing that's being done, keeping in mind, or for those people that had significant gains in their equity portfolio, we've seen some people take gains to harvest those in the spirit of your question about, well, if that's going to be inversion's going to stick around and it's actually going to have some staying power, if that's going to be an indicator, maybe we should take some of our gains off the table and redeploy them into higher quality core fixed income. I'd say those are the things that we're seeing right now, but nothing has causing us to really say that an inversion right now is anything that is permanent. We've seen a lot of gyration with what's going on in the market recently because of all the volatility. I think once we get through the holiday and into the first of the year, that'll be a good proxy to look back because everybody's back from the holidays, and you'll get a better sense on how the markets are thinking about things historically after the Christmas holiday ends.
Well, Dan, and to our attendees, thank you so much for taking time out of the day to join us. Dan, I'm really grateful for your knowledge and insight that you shared. And for our folks who are listening in, I want to remind you that an audio recording of the webinar and slides will be available on our website in an on-demand fashion in case you want to share that information with any of your peers or colleagues. If you have additional questions or comments, please do send us an email and we'll work to get your questions answered and to follow up. So thanks again for joining us, and we hope to see you in March at the 2019 Governance and Leadership Conference. Have a great day, everyone, and thanks again for joining us.